The Federal Reserve has a $1.5 trillion secret weapon that they can use to combat rising interest rates whenever they choose to do so. What's up, everybody? My name is Joe Brown. This is Heresy Financial, and as you can see, I'm out in the middle of nowhere right now. I'm driving back from Denver, Colorado. Met so many of you there. We had a blast at the meetup. If you weren't able to make it, don't worry, we're going to be doing some more, and I'll be announcing the details when we have time, date, place nailed down. But right now, driving back, and thought I'd share with you guys, I was speaking with Jim from Wall Street Silver in Denver about the Federal Reserve's reverse repo facility. We were talking about the reasons behind it and what's really going on there. And I was talking about, things that I've shared with you guys a lot, which is basically the Federal Reserve had to jack up the rate on their reverse repo facility to soak up a lot of the excess cash from the system. And so what was going on there, if that doesn't make any sense, the repo market is where financial institutions go to get their hands on cash when they have extra collateral and they need some cash. Lehman couldn't get their hands on cash because all their collateral was mortgage-backed securities back in the day. That caused them to shut down. More recently, the problem is everybody was flush with cash and couldn't get their hands on enough collateral. Now, from March of 2020 through March of 2021, that was not an issue. The system was flush with cash, and nobody cared about the collateral. Financial institutions, remember, if you're a bank, cash as a deposit is a liability for you because they owe that money to somebody. That's a liability on their balance sheet. So they need, in normal times, they need collateral to offset that liability, an asset on the other side of their balance sheet. And but from March of 2020 through March of 2021, the Federal Reserve lifted the requirement for financial institutions to have that collateral on their balance sheet. And so they didn't care how many deposits they had, what their liabilities were. It just didn't matter. Then they let that expire. The supplementary leverage ratio is what it was called. They let that suspension expire at the end of March of 2021. And that is the time when you saw the reverse repo usage start to increase. And then following that, the federal government was spending and spending and spending money out of the Treasury General account. That was their checking account because there was a lot of money in there. They weren't doing any extra borrowing at that point. So the Federal Reserve was like, look, we know there's a lot of cash coming into the system. We know that these banks are going to have a lot of liabilities and they aren't going to have the collateral to be able to offset that. So what they did was they increased the rate that they were paying on their reverse repo facility. That meant any financial institution could go to the Fed, give them the cash and get collateral back for it, and then at some point in the future close that transaction out. It's a repurchase agreement. So they agree to give the cash back for the collateral at a certain point in the future. The Fed raised the interest rates on that. And so the question is, why did they do that? Well, the system was flush with cash, but that's not the whole story. And this is something that Jim pointed out to me, which, it's something that I haven't said before, but it makes perfect sense. It's because if they wouldn't have done that, it's not like there wasn't enough collateral, like that nobody could find short-term bonds in order to buy. It was out there. Anybody could have bought it. The reason is because if everybody would have deployed, those $1 trillion, $1.5 trillion into the bond market to buy short-term government debt, it would have pushed short-term rates negative. So it wasn't like it just wasn't available. It's available for purchase. It would have pushed the prices up so much because there was so much money ready to buy that it would have made rates go negative. So now, there's $1.5 trillion in the reverse repo facility at the Fed, and at any point the Federal Reserve wants, they can shut off that 0.05% that they're paying on that, and that will go back down to what it was paying before, 0.01%, and then all that cash will leave the reverse repo facility and go back out into the short-term government debt market and buy up short-term government debt, and that will put a lid on interest rates for about $1.5 trillion worth of cash that needs to find collateral. And so right now that's still in the reverse repo facility until rates get to the point where the Federal Reserve is uncomfortable with how high short-term rates are getting, and at whatever that limit is, we don't know what that limit is, that is their $1.5 trillion secret weapon that they can use to deploy back into the short-term government debt market. Right now, all that cash is in that reverse repo facility. That'll all flood out and go to buy short-term government debt, which will push up the price. push those rates down, and that'll be a buffer, that'll be a cushion for extra debt to get issued by the government without raising interest rates too much. Hope that makes sense. Let me know. And if it doesn't make sense, I'll answer any questions that I can in the comment section below. As always, really appreciate you guys. Thanks so much for watching. Have a great day.